The world is quietly abandoning the US dollar. China is dumping treasuries. Japan is in a currency crisis. The Fed is trapped. And Bitcoin, an asset that was supposed to be uncorrelated to traditional finance, just got crashed 30% in a week, while traditional equities barely flinched. These aren't separate stories. They are the same story, playing out across different markets. Hi, I'm Igor. I'm investment director at Venionaire Capital, your entrepreneurial partner, and this is the Crypto Insights. As we all know, Bitcoin took another hard hit. There are a number of correlated and intertwined factors at play. There is no single isolated event, no single bad guy, culprit to point our fingers at and call guilty. But there are some big players who can stir up trouble. Bitcoin is already greatly, I would say, institutionalized and integrated into a global financial system. What unfolded last week, and especially on the last Friday, I would say deserves an episode and a deep dive of its own. Maybe for now, just let me share with you the big picture, or at least the outline of it. Last week, Bitcoin had one of its most violent single-day declines in its history. But the price crash was not a simple market panic. We had record IBIT options volume of 2.33, million contracts, and nearly 900 million in premium trading occurred, while spot IBIT ETF itself actually saw net positive inflows on the week. This is a paradox, and it's a paradox of having massive selling pressure coinciding with institutional buying, which reveals there is something more complex than merely directional weakness. What we can see here on the chart is Bitcoin price overlaid with implied volatility. I think one can say that volatility was used as a weapon. The conditions for what followed were established months earlier. What happened on the last Friday started essentially months earlier. Look at this implied volatility chart. By September 18th, Bitcoin implied volatility had collapsed to around 35%, which is a historical low, far below the 60% that Bitcoin typically experiences. For sophisticated traders, this presented a clear arbitrage opportunity. Volatility was mispriced. When implied volatility is this cheap, the same capital can purchase multiple times more option contracts than it usually would. A well-capitalized, let's call it entity, recognized this opportunity and began building positions back in September 2025 when options were at their cheapest. So how does this gamma create market impact? To understand what happened, we need to understand how options mechanics can amplify market moves. So let's look at this simplified illustration of a put ladder strategy. When large put positions are accumulated at multiple strike levels below the market price, they create potential forced selling points as Bitcoin's price declines. As the price approaches each strike level, option dealers who sold these puts must hedge their exposure by selling, you've guessed it, spot Bitcoin. So each level of the ladder on the left side adds to total forced selling pressure, creating a cascading effect like a staircase where each price level triggers more selling, which pushes the price to the next lower level, which then again triggers even more selling. This mechanism works in both directions, not only to the downside, meaning call ladders create forced buying during rallies, for example. The infrastructure doesn't care about direction. It just amplifies whatever move is initiated. So I want to maybe show you an interesting graph regarding the timeline and discuss it a bit because I think this preparation over months and months is very interesting. Building this kind of position takes time, and execution also takes infrastructure, very, very careful planning, and also patience, but it requires also a lot of capital. So the currently available evidence suggests this unfolded in distinct phases. October, December 2025, our first, let's say, phase, a sophisticated entity, likely with market maker privileges and with access to opaque OTC derivatives markets, accumulated massive cheap put options during the low volatility environment. And these positions gave them downside exposure with significant gamma, meaning they were Bitcoin price to fall, their positions would become, let's say, exponentially more profitable. So let's call this sophisticated market participant the operator. Then we have the execution cycle. The strategy then shifted to active, I would say, exploitation. Bitcoin prices drifted lower overnight and on weekends. Those are periods when liquidity was thinnest. At the New York Open the following day, option dealers were forced to rebalance by dumping IBIT spot to hedge their delta they had accumulated during the overnight move. This created cascading selling pressure. The cycle repeated weekly, and later it actually switched to 3 times per week. Why? On Mondays, Wednesdays, and Fridays, it was now possible to execute instead of only once per week because NASDAQ approved new expiry dates in late January this year, giving the operator actually sort of a machine gun for their execution instead of just a rifle with shooting single shots. By December, the first leg of this execution strategy or strategy execution closed presumptively to or likely to avoid the 13F filing requirements with the SEC. 13F is relevant for institutional investment managers that have minimum of $100 million securities under management. But with massive profits already accumulated, the operator built a fresh ladder in January 2026, positioning for one final push before there is a regulatory change with regards to Clarity Act and before 24/7 futures trading by CME would be activated, essentially closing the loophole. The last phase was February 5th, 2026. The trigger. The irony is that the final crash was not orchestrated by the sophisticated operator in isolation. Instead, it was also triggered by the opposite side of the trade. Hong Kong-based hedge funds holding large IBIT positions faced margin calls from broader market deleveraging. Their forced liquidation created the initial selling pressure. But here's where market structure becomes, let's say, destiny in a way. The systematic selling hit the accumulated put ladder we discussed previously at exactly the wrong price levels. Dealers' hedging requirements exploded. The cascade became unstoppable. What might have been a 10% correction became a 30% weekly decline. There are multiple theories that actually do not negate one another, and single culprit explanation, depending on the available data, might fail. However, the February crash wasn't solely orchestrated manipulation by a single entity. There were 3 converging factors that amplified the initial move. The first theory is this sophisticated operator, a well-capitalized entity that exploited volatility mispricing and market structure vulnerabilities through repeated weekly gamma cycles, building massive downside exposure in the process. Another theory is there has been a massive influence by the use of structured products. Banks hedging barrier knock-in notes on IBIT were forced into aggressive selling as Bitcoin approached barrier levels. This added forced selling beyond just the options ladder. And the last theory is multi-asset deleveraging. Broader risk-off sentiment hit, for example, software stocks and also precious metals over the past few weeks, meaning simultaneously multiple correlated market shifts that were unfavorable for overexposed positioning. Multi-strategy hedge funds faced margin calls across multiple positions, making Bitcoin's inclusion in their portfolios actually a liability rather than an asset. So the data shows that all 3 theories were likely true simultaneously. Total net delta positioning swung to minus almost 400 million by the 10th of February, with the most violent delta swings occurring on the actual crash day, thus suggesting reactive forced hedging rather than a single pre-planned strike. But this reveals his structural vulnerability in modern markets. Bitcoin is, I would say, no longer a standalone asset. it became embedded in spot ETFs with, for example, IBIT had 10.7, almost $11 billion dollars daily volume. And this volume capability on a daily basis is remarkable. Options on those ETFs for IBIT, for example, you have position limits that can be bypassed through OTC market. Then we have structured products with barrier features, basis trades, linking spot to CME futures. We also have multi-strategy fund allocation. So each layer has its own hedging mechanics. And when they all activate simultaneously, the amplification of price movements is exponential. On this visual here on this chart, I'm showing you this inverted pyramid that shows you derivatives that are layered now on spot Bitcoin. So the notional volume is much, much higher than the mere capitalization of Bitcoin based on a capped number of coins in circulation or in existence. To mention some key data points, we have several factual markers that support this, I would say, deep dive analysis. IBIT options volume reached 2.33 million contracts on February 5th alone, which is a record highest volume. And we also have, as I mentioned, options premiums that traded totaled around 900 million, which is also a record. Yet IBIT saw net positive inflows, which to me indicates institutional accumulation despite the crash. We also have call open interest, 4.1 million contracts, and put open interest was at 2.6 million contracts. So the crash occurred despite stronger Bitcoin fundamentals that we've had during 2022 bear market, for example, or in the previous years. This combination of massive derivative activity with institutional inflows indicates sophisticated market structure dynamics rather than just simple capitulation because of over-leveraged retail positioning. Critically, this infrastructure works in both directions. As I mentioned, the same gamma mechanics that amplified downside movement this time around can also create explosive rallies. When leverage is normalized and fresh capital enters, the same structures that created this 30% weekly decline can also fuel moves in the opposite direction with equal violence. As one analyst noted, if I may quote, whenever the melt-up comes the other way, it's going to be more vertical than ever before. The infrastructure that crashed the market is now primed for the opposite effect. Some lessons that emerge from February crash. For me, Bitcoin is now a derivatives-driven asset. So understanding option mechanics, gamma exposure, and market structure is as important as understanding the underlying technology or fundamentals. Liquidity is, I would say, conditional. IBIT's $10 billion daily volume capability is real, but it's built on an interconnected derivative structure. When multiple hedging mechanisms activate simultaneously, liquidity evaporates. Then we have also regulatory gaps that create systemic risk. The opaque OTC derivatives markets I've mentioned for IBIT options, they operate without position limits or transparency. So Nasdaq's request to increase position limits from 250,000 to 1 million contracts in January reflects awareness that the real exposure lives in unregulated OTC markets. To close it and maybe include a forward outlook, Bitcoin's integration into traditional finance goes deep. The same institutional adoption that enabled this February crash also creates the infrastructure for explosive future moves to the upside. For me, it begs the question how the retail should navigate Bitcoin's evolution from, let's say, a crypto native asset to a form of hybrid financial instrument sitting on both chairs, crypto and TradFi, having characteristics of both store of value and risk on asset that has volatility characteristics of options derivatives driven volatility. The February crash was maybe Bitcoin's welcome to the Wall Street moment. It demonstrated that institutional adoption. The February crash was maybe Bitcoin's welcome to Wall Street moment. It demonstrated institutional adoption that brings both opportunity and also structural risks that didn't exist when Bitcoin was a pure crypto asset some years ago, or just a few years ago, 3-4 years ago. So, and maybe as a final reminder, the crypto industry is expecting over 100 altcoin ETFs to get approved and launched in 2026, meaning the Bitcoin evolution is spreading to altcoins as well, and the game just got an upgrade.